tax, like you're a tax professional, people look at you with one side eye. I've had encounters, people say, so you're the one collecting our money. And I'm like, no. In fact, I'm even working for you because my own job is to ensure that you pay the least possible tax within the bounds of the law, to ensure that you don't evade taxes and then you don't overpay taxes. So let's jump right into it. Joshua 17:19. It says, yet it came to pass when the children of Israel were waxing strong that they put the Canaanites to tribute, but they did not utterly drive them out. So you see, there's a history here. Then there's Matthew, where Jesus himself, they came to collect taxes, and Peter just told them, yes, my master paid taxes, and he left. But Jesus reprimanded him and asked him to go and pick money from the mouth of the fish to show that Jesus too was complying. Then Romans 13, if you say, that's Old Testament. Romans 13, verse 6, I'll go straight to verse 6. It said, pay your taxes too, for these same reasons. For government workers need to be paid. They are serving God in what they do. Give to everyone what you owe them. So taxes, as we see, both historically, from a historical perspective and from biblical perspective, is something that should be done. And it's our obligation to do it without being coerced, right? And we see from ancient civilizations, like you can see on the slide, Egyptian Empire to the Babylonian Empire to the Roman Empire, even up until the British Empire. In fact, when I was doing this research for this presentation, I discovered that a large chunk of these empires was built through the administration of taxes, of taxation. I'll just play a short video here for you.
Teacher, we know that what you say and teach is right. We know that you pay no attention to man's status, but teach the truth about God's will for man. Tell us, is it against our law for us to pay taxes to the Roman emperor or not?
Careful, Lord! He'll try to trick you!
Show me a silver coin. Whose face and name are these on it?
Caesar!
Then render unto Caesar the things that are Caesar's, and to God the things that are God's.
Yes, so, when I first saw this video, I was telling my wife that if I was one of the disciples, the moment Jesus drops this punchline, I'll raise my shoulder up and be like, wow, wow, wow. Because he shuts them down, right? He used divine wisdom to show that we're supposed to fulfill our obligation without being mandated, without being coerced. And you might be asking yourself, why taxes? Why are we supposed to pay tax? What's the canon? What's the principle behind taxation? And I'll draw you to the canons of taxation. There are 4 canons here. There's equity, there's certainty, there's convenience, and there's economy. Equity means taxes, the administration of taxes, the imposition of taxes should be fair. Rich people should pay higher taxes, while the low-income earners should pay low. Like there should be a direct relationship between amount paid and income. You don't expect me to pay taxes beyond my income, and that's even what this legislation is trying to address. These new tax reforms, the government doesn't want to tax poverty, because over the few months when this thing was announced last year, I've had comments, people say, government wants to take more money from us. Government wants to tax poverty. But if you look at the holistic picture, you discover that it's a people-centric legislation. If you've taken your time to read through or skim through or even attend any of the seminars, the laws, the legislations were proposed in order to ensure that people pay equitable taxes, such that you don't overpay and you don't underpay. And eventually, when the system is working, people are happy paying their taxes, right? Then certainty, how much you should pay, when you should pay it, how it should be paid, should be certain. There shouldn't be any ambiguity. Convenience, the tax administration should be in such a way that it's convenient to pay. If I live in Lagos, you shouldn't put my tax office in, say, Plateau State or Benue State. That will not be inconvenient. Then economy, cost of taxation, cost of collecting taxes should be low. That's the benefits and cost-benefit analysis. Now, why should I pay taxes? You may be asking yourself. Because, okay, ideally speaking, you should pay taxes to help government. But in a situation where you pay taxes and you cannot tie the amount paid to to the infrastructure, it becomes a burden. So I came across this clip and I just wanted to watch.
Why should I pay taxes when dollars don't? Why should I pay taxes when dollars won't? Half the population is dumber than they are. Is it 'cause they don't own houses or driving fancy cars? Why should I pay taxes? 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 Are they doing this on purpose? Why should I pay taxes?
So why should I pay taxes? An interesting question. I just want to propose some schools of thought here, and some people may not agree, but it's actually very important that we pay taxes, right? And I'm not speaking from a government perspective. Now I'm speaking from the perspective of someone who's from a responsible citizen, right? You should be able, just the way we pay to support any system we're part of. That's what taxes should be, right? So there's the ability to pay principle. It's one of the principles of taxation. And this principle simply says that taxes should be administered based on your ability to pay, right? Like I explained earlier, if I'm a high income earner, I should pay higher taxes than someone who is a low income earner. There should be a direct relationship between amount paid and amount earned. That's what the ability to pay principle is talking about. And there's a benefit receipt theory. This theory just goes to say, it mentions a quid pro quo system, right? You should pay, it's just like a transactional relationship between government and its citizens. And what this means is, if I'm receiving, say, to quantify it now, if I'm receiving service worth of $50 or 50 naira or 50,000 from the government, then my taxes should be equivalent to that amount. That's what this principle is talking about. And there's a lifeblood doctrine. This doctrine is saying that taxes are the lifeblood of a nation. Without taxes, the state cannot run and effectively carry out its activities. So individuals, companies, businesses should pay taxes. And there's a necessity theory. And what this means is that it is a necessity, like it is important that taxes are paid, and so everyone should comply. And finally, there's the doctrine of symbiotic relationship. And this doctrine simply assumes that there's a reciprocal relationship between government and its citizens, right? If taxes are not paid, government cannot function in a symbiotic relationship. So in order to ensure government is functioning, citizens should pay taxes. So of these 5 theories, it is, I'll leave that to your judgment, but whichever one you want to decide. But summarily, you see that there's an underlying principle that there exists a social contract between the government and the state. This is the background we need for this study, because if we go through this presentation and you still don't appreciate the fact that taxes are very important, then you will feel cheated, you will feel shortchanged whenever it's time to pay taxes, or whenever the government is chasing you or chasing your business. You need tax clearance certificate and it's not forthcoming. You want to do business and they're asking you for evidence of tax paid, and you feel bad. But when we understand this principle, then it becomes easy. You can pay taxes with joy and with happiness. I will move to the tax reforms itself. You know, in 2023, the president, when he came on board, he appointed, in part of carrying out his activities, he appointed Mr. Taiwo Oyedele as the head of the Presidential Committee on Fiscal Policy and Tax Reforms. And they had a mandate, because Nigeria had so many legislations. In fact, there were taxes that were being administrated twice. The state is collecting, the federal government is collecting. Same tax, same revenue head. And they looked at it and they were like, no, this thing should not be. In order for us to have a harmonized tax system, there's need for a reform. And it's important to know that no serious tax reform has occurred in Nigeria since the 1990s. What we've had, in fact, that was under President Muhammadu Buhari, we had finance acts released every year trying to patch up. But for there to have been a real reform, there was a need to go back to the foundation. And so he inaugurated this committee and tasked them with this function, with this mandate, to reward the entire tax system, to rejuvenate it, to make sure that Nigeria's tax system is comparable worldwide. And they got to work, they set out, and in 2024, they released 4 bills proposing the tax reforms. And these bills are the Nigeria Tax Bill, Nigeria Tax Administration Bill, the Nigeria Revenue Service Bill, and the Joint Revenue Board Bill. And we also what happened in news from presidential assent, or from when it was sent to the House. Even before it was sent to the House, they had to go through several stakeholder engagements, even up until the point with governors. He had several sessions with the governors, with the Senate, the House of Reps, and eventually they came to a conclusion. The Senate and the House of Reps harmonized the bills and eventually sent to the President for assent. And on the 26th of June 2025, landmark day, the President signed all of the 4 bills into law, indicating a new landscape, a new tax landscape in Nigeria. And like I said earlier, just to mention and to reiterate, these tax bills are not meant to be punitive. In fact, they are people-centric, they are citizen-centric, they are focused on the citizens and focused on the ease of doing business. Because if you look at it, no country in the world has ever grown its revenue or achieved development by taxation of poverty, right? At a point, Nigeria was classified as the poverty capital of the world, and this was not good at all. And they looked at it, and if you continue to tax people who are not really doing well, when the economy is very bad and you keep imposing taxes, eventually you kill businesses. And it's businesses that generate the GDP, that generate income from which you derive taxes. So if you kill the hen that lays the eggs, then there's no hope for eggs in the future. So just to correct that mindset, that these bills were introduced to ensure that Nigeria is on the path to progress. And I don't have time to go into the economics, but because of the things we saw in the past and the way taxes were being administered, we would have not survived, say, 10, 20 years max. Nigeria would have been a failed state. I say that with every sense of responsibility. But so it's very necessary that you appreciate the work this committee did and come to terms with the fact that these bills, these acts, as it were signed to ensure that Nigeria is put on the path of progress and the citizens are happy and taxes are administrated in such a way that is fair for everyone. And it's important to note that these versions, the signed versions, have not been officially released, although they've been signed by the president. And the chairman of the committee, Mr. Taiwo Diedele, he gave his explanation that the reason it's not been made public is because between the time the bills were transmitted from the House of Reps to the president for assent, there was a lot of it was not properly, their thoughts were not properly captured, so to say. So you have to review the bill again, and eventually it will be released from, I think from the indication he gave, by this time next week, I think it should be out, because as at yesterday, there was a committee that met and he gave some updates during the meeting. That was at the PwC stakeholder engagement. He gave some comments indicating that the bills were already being printed. And so it will eventually come out. Sorry, I have to rush because of my time. So like I said earlier, we have 4 bills. Nigeria Tax Act. This act simply consolidates all the numerous tax laws we have here and there, scattered. It has consolidated them, the capital gains tax, company income tax, personal income tax, stamp duties. All these acts have been consolidated into one act now. So you have one booklet that you can pick up. This is Nigerian Tax Act. This is the law that speaks to taxes in Nigeria. Then tax administration. There's this law gives credence to how taxes are administered in Nigeria. So prior to this time, you had FIRS, you had state boards, like for Lagos State, we have LIRS, then you have all these other state taxes. And you don't really know who should collect what. And so it gave rise to a multiplicity of taxes. The government is collecting one, state government is collecting, even local governments are even collecting theirs because they have their bylaws. But with this Nigeria Tax Administration Act, it's very easy for you to now say, no, you don't have jurisdiction to collect or to assess me to this tax because there's a Nigerian Tax Act. The Nigeria Revenue Service Act, this one repeals Federal Inland Revenue Service and establishes the Nigeria Revenue Service as we know it. And this service is responsible for collecting all federal government revenue. Prior to this time, FIS was charged with the responsibility of collecting taxes, but now they're going to be, their scope is expanding to beyond taxes. They're going to collect royalties, stamp duties, everything that's accruing to the federal government will be collected by the Nigeria Revenue Service. And it makes it easy for administration. Then we have the Joint Revenue Board of Nigeria Act, and this act establishes the major update here is the establishment of the tax ombudsman. And this body is charged with administrating taxes, ensuring that there's a handshake between tax authorities and individuals. So if you have a dispute with any tax authority, or if you've been wrongly assessed to tax, the tax ombudsman is your go-to. So because of, like I said earlier, the laws are a lot. We will focus more on the Nigerian Tax Act. So for businesses, what are the implications for businesses? We have minimum effective tax rate now. So what this simply means is that there's a 15% minimum effective tax rate, which has been established. And this 15% effective tax rate is calculated based on your profit before tax as reported in your financial statement. And what this essentially means is when you file taxes and you file your tax returns at the end of the year as a business, your tax rate, and this is the exemption here is for small companies, I'll come to that later, but your tax rate should not be, your effective tax rate should not be less than 15%. An effective tax rate is the total of your taxes divided by your profit before tax or your net income. And net income is defined in the Act as profit before tax. In the version that we have, the latest version, profit before tax less 5% of depreciation and personnel costs. So if you take your profit before tax as reported in your financial statement, you take away 5% of depreciation on your assets and personnel costs, and then you compare that with the total taxes you've computed. If it is less than 15%, the law provides that you must make up for that shortfall to ensure that your effective tax rate is 15%. And this applies to large companies because small companies are exempted. Then there's the development levy. So before now, we had Naseni levy, we had education trust fund, education tax, we had police trust fund, we had NITSDA levy. There were a lot of levies that companies were paying, and it was duplicated. It was just too many taxes to be paid. And so they looked at it that instead of paying all this, why don't we just aggregate everything? And when you pay your company income tax, you know that the only other thing you are paying is a development levy. So this development levy is established at the rate of 4% of your accessible profit. Like I said, prior to this time, we had accessible profit. We had education tax, which was 3% of accessible profit. We had Naseni levy, which was 0.25% of profit before tax. We had police trust fund levy, which was 0.005% of profit before tax, and several other levies. If at a point they went introduced NYSC levy, and all these levies, the Act is saying don't overburden companies. Just take 4% of profit of accessible profit, and that's it. So you have your company income tax, you have your development levy. But there's a caveat: this does not apply to small companies, and it does not apply to non-resident companies. So we have a small company definition, and for professionals who are looking into establishing companies, or you run your small business, the Act has come to define what a small company is, or to redefine. Because prior to this time, a small company was defined as a company with turnover of gross turnover of 25 million or less. So before now, we had small companies, we had medium companies, and we had large companies. Small companies with turnover of 25 million. So turnover is sales, your aggregate sales for the year, for a 1 year period, or for your accounting year from when you start is usually 12 months. So if your accounting year is 1st of April, so 1st of April to 31st of March, if you compare it and your turnover for that period is now up to 25 million, before now you are classified as a small company. But right now that definition has changed. It has been increased from 25 million. The version that was initially sent to the House of Reps is 100 million. But now the latest version we have is 50 million. But we don't know what the final version is going to be. But based on what is available now, the small company threshold has been increased from 25 million to 50 million turnover. So if your turnover at the end of the year, if your aggregate sales is 50 million and you have fixed asset not exceeding 250 million, then you are exempted from paying taxes. And this essentially means you're not going to be paying company income tax, You will not suffer withholding tax on your invoices when you purchase. You're not supposed to issue vatable invoices, right? So they are doing this, and the goal is to ensure that small companies thrive, because the Nigerian economy is boosted by small and medium scale enterprises. And if these companies are doing well, bringing in investments from all over, then there's more revenue. And when there's more revenue, there's more taxes, right? But if the companies are not doing well, you are withholding their working capital, they can't do well, they can't take loans because interest rate now, MPR is about 27%, and that's too high for any company to want to take loan and expect to do well. So the reason this was redefined is to ensure that small companies do well. So if you're into, you sell hair, whatever you do, just your business is thriving, just ensure that you keep proper records, because that's been the bane of Nigerian businesses, the lack of proper records. Ensure you keep proper records to show that your revenue is not beyond the threshold. And once you can prove that it's not beyond the threshold, then you qualify for this exemption. And it is important to note that in computing the turnover, disposal of assets, that's capital disposals, is not part of turnover. That's just to protect companies. And we have indirect transfer of shares. Sorry, I have to run. My time is flying. Indirect transfer of shares. If shares are transferred, so this applies to group companies. There's a group company, and then you have a subsidiary offshore. This law has come to say that if there's an indirect transfer of share that results in a change in the ownership structure of a Nigerian company, prior to this time, say I have a company and I have a subsidiary. The subsidiary disposes shares. It triggers capital gain tax for the Nigerian entity, because if I dispose my share in that subsidiary, I earn capital gains. Capital gains is how do I explain this now? Okay, capital gains is capital gains, right? There's this distinction between trade income and capital gains. Capital gains is when you sell capital assets like land, building, machinery. When you dispose of all this, it's capital in nature. It's not recurrent expenditure. When you dispose of all those things in an offshore entity, if that disposal results in the change in ownership structure of a Nigerian entity, it means it triggers capital gains exposure. And we have controlled foreign companies. This is interesting. For companies who have offshore entities, the law has provided that if a Nigerian company has an offshore entity and that offshore subsidiary does not declare profits or pay dividends, FIRS, or the Nigerian Revenue Service, will assess that subsidiary and determine if it could have paid dividends without affecting its operations. And if they ascertain that it could have paid dividends or distributed profits without affecting its operations, then they will assume that those profits have been paid to the Nigerian entity and subjected to tax. The reason is to discourage movement of funds offshore. So if they don't declare those profits, FIS, Nigerian Revenue Service will assess it and assume they've been declared. Moving on, taxation of digital assets. Yeah, it's a digital age. So this has provided that digital assets are now subject to taxation, subject to tax in Nigeria. And digital assets like your crypto, your online trade, all these assets have now been brought into the confines of the law. But the challenge here is the law provides that taxation is paid in the currency of transaction. I know one of the challenges with digital assets is such that you can't really trace, there's really no trail, especially the blockchain technology. So you can dispose of crypto without anyone knowing. But eventually, I believe the service will release guidelines on how this is going to work. Then elimination of medium-tier companies. Like I said earlier, the small companies turnover of 25 million or less. Medium companies was turnover between 25 and 75, and then eventually large companies between 25 and 100. Then anything above 100 million is a large company. But now, medium companies have been eliminated. Small companies with 50 million turnover, and fixed assets not exceeding 250 million naira. So we have all these small companies taxable at 0 rates and large companies taxable at 30%. Thin capitalization rules. This is for borrowings. So before now, thin capitalization rules applied to only foreign loans. So the law provides that if within a group structure, if there's a loan that was taken, the tax deductibility is restricted to 30% of earnings before interest and tax. But now it has been expanded to include both local loans. So if you take a loan between entities within a group that's related parties, it has been extended to both foreign and local loans. Then we have the modified REN rule. So tax deductibility of expenses before now follow the wholly, reasonable, exclusively, and necessary test. It must pass these 4 tests. But now, exclusively and reasonability and necessary rule have been taken away. It's just wholly and exclusively. So if you can prove that your expenses are wholly and exclusively taken for business, then it will qualify. And what this essentially means is that you now have more headroom to take expenses. VAT, this is very, very important right now, because in the initial version of the bill, there was a proposition to increase VAT from 7.5 to 10% and progressively, because Nigeria is the only country with a single, well, not the only country, but it's one of the countries with single-digit VAT. A lot of countries, even in advanced economies, have double digits, even up to as high as 20% VAT, but VAT has been maintained at 7.5%. And this is very important because small businesses are exempt from issuing VATable invoices. And then there's an obligation to ensure that VAT is filed before the 21st of every month. However, small companies are once again exempt, but there's a caveat. It's not compulsory, but it's optional for them. So you can choose as a small business to file your VAT returns. I will come to that eventually. It's just to create a trail, right? But because the thing is, sometimes you don't know when you've crossed the 50 million threshold. So if you just maintain the filing, it's as simple as just going on your portal and filing the returns, even if it's zero returns. Whether you make purchases, whether you make VATable supplies or not, you're supposed to file VAT. And finally, capital gains from disposal of shares. Capital gains was taxed at 10%, but right now it's taxed at 30%. And I move on to taxation of, I'm just going to rush. The previous provision of the law is that taxes on individuals are paid based on residence. You determine your residence, and then that's where you pay taxes. Say a resident in Lagos will pay tax in Lagos. A resident in Ogun State will pay tax in Ogun State. A resident outside the country but earning income from Nigeria, right? Employment income will be taxed in Nigeria. In fact, the Act provides that the employer should deduct this pay as you earn. You deduct that tax and then you remit, because the employment, especially where the employer has a fixed base in Nigeria. But right now, the Nigerian Tax Act is proposing a citizenship principle such that wherever you are in the world as a Nigerian, your global income is subjected to tax, especially with the advent of the Japa syndrome. Many people are leaving the shores of the country, and once you leave, say bye-bye to Nigerian taxes. But now it's going to change. If you earn income from Nigeria, you'll be taxed in Nigeria. And if you earn income, say you move to somewhere like Canada or you move to the UK, and your income is tax exempt there. To the extent that they're not taxing you in that country, you're supposed to remit tax to Nigeria because you're a Nigerian. So the administration of taxation on employment income is now on a citizenship principle, no longer limited to residency. So, based on the provisions of the Act, taxes are levied on your chargeable income. And your chargeable income, you get to your taxable income first, take away total deductions, you get to total income. From total income, you take away eligible deductions. And it looks like a lot. Your taxable income is a sum total of everything that comes into your account, except some exempt income, which are not liable to taxes. I'm rushing. So for taxable income, accessible profits from trade, from business, from profession or vocation. So if you say, I'm doing business, subject to tax. Say, no, my own is not business, so it's trade I'm doing, I'm just buying and selling. You are still in a tax net. Or if you say, I'm a professional, I'm a lawyer or whatsoever, you are still subject to tax. So the idea is that no matter the bracket you fall into, the tax net, you must fall into the tax net. Then there's employment income. The onus here is on your employer to deduct and to remit. And there's income from investing activities, like I said earlier, the chargeable gains. and there's profits or income from any other source. And this is the reason why I was emphasizing the fact that we are supposed to comply without being penalized or without being coerced, because now the law is providing that profits or income from any other source. So if you work in an organization and you receive your salary at the end of the month, the company deducts taxes and remits on your behalf, and you have a side hustle. Say you are a seamstress or a fashion designer, you make clothes. The Act expects you, because Nigeria operates a self-assessment scheme, you're supposed to assess yourself to tax and pay. The onus is on you as an individual. After your employer has remitted the payee, the tax deducted from your salary, and you're supposed to quantify the profits you are making from your fashion designing and include it in the tax and include it to your returns at the end of the year, and file and pay the taxes the tax on the profit you make from your fashion designing business. Interesting. And finally, we have chargeable gains from disposal of chargeable assets. Chargeable assets are assets that upon disposal, they create tax liability. Like, say, for instance, you buy land, you dispose the land, is a capital transaction. Or you have a car, you dispose the car, it's a capital transaction. So you compare the disposal proceeds with the costs, and then you have chargeable gains. Or what the law has provided for now is that you compare the disposal proceeds with the tax written down value of the assets, and if there's a shortfall, you have a tax loss. Or if there's an income, you pay CGT on that, and it's at 30%. So there are deductions, like I said earlier, taxable income minus total deductions will give you your total income. So you're permitted to deduct your losses, capital allowance, exempt income, and then income on which tax has been deducted at source, like dividends, like interest. When the bank is paying you interest, they're deducting withholding tax on it. They are paying you dividends, except it's dividend from a real estate investment trust. So all these deductions are applicable, right? So the eligible deductions, you might be asking, they are changing these tax laws. What headroom are they giving to us to ensure that we reduce our taxes? So the law has provided for some eligible deductions. You have the contributions to the National Housing Fund, although there was a legislation released in 2023, the Miscellaneous Income Ease of Doing Business. It says National Housing Fund is no longer compulsory for private companies, but for those in the government, it's compulsory. But for private institutions, it's no longer compulsory. You can choose to opt out of the scheme. But if you want to take deductions from your taxable income, you can consider this option, and it's at the rate of 2.5% of your monthly basic salary. Then contributions to the National Health Insurance Scheme is also tax deductible. Then pension, employer remits 10% and the employee remits 8%. That 8% is tax deductible. Then interest on loan for developing your own house. If you're buying your own house and you say you take a mortgage, the interest on that mortgage or the interest on loan in developing that house is tax deductible. Then you have annual annuity, which is insurance, life assurance for you and your spouse. It is tax deductible. And the major one now that is introduced by this Nigerian Tax Act is the rent relief, which is 20% of the annual rent paid. Annual rent paid, subject to a maximum of 500,000. Meaning, you take the rent you paid, take 20% of it, and then you compare it with 500,000. Whichever is lower is what you take as your tax deduction. And the interesting thing here is that the Act provides that you must provide evidence of payment of that tax, and you must provide the name of the landlord you're remitting that before you can take tax deduction. So you might be asking yourself, what if I don't do all of this? The Act has introduced a presumptive tax regime, meaning if you don't keep proper books of records, if you don't assess yourself to tax, if you don't do all these things, and you feel you want to ghost the system, anyone who tries to ghost the system, the law has provided for a presumptive taxation principle such that they can just slam you any amount, right? Or they can compare someone earning similar income or earning similar profits from the trade you are doing, and then slam that tax on you. And it's interesting to note that with this tax legislation, the cost of compliance is cheaper than the cost of non-complying, because there are strict penalties ranging to the tune of 200,000 for not filing or not paying of taxes or not registering or not even allowing the VAT fiscalization system, which is the implementation, the integration of technology by the tax authorities into your system to ensure that the money is tracked end to end. If you don't allow that, there's strict penalties, and the penalties are meant to deter people from not complying, because non-compliance is actually very expensive now. So these are the rates under the two regimes: personal income tax as it is now and the Nigerian Tax Act. Because the reason it's important to understand this is to know how it affects you as a person if you're earning employment income. Because prior to this time, the bands to my left, you have income is taxed. Your first 300,000, the highest you could have been taxed is 24%, and it's applicable to income above 3.2 million naira. Right now, the law has been rejigged to ensure that the first 800,000 is taxed at 0%. And the reason this is done is from the research that was done by the committee, about 90% of the Nigerian populace will be exempted from taxation just by implementing these tax bands. Because the first 800,000, the next 2.2 is at 15%. And if you look at it, if you juxtapose these two positions, you discover that anyone earning below 2 million a month, you just see a marginal increase in your tax. But if you don't earn up to 2 million a month, then there's going to be a decrease in your tax. I was expecting someone to clap for the committee. So moving on. Okay, moving on, there are reliefs. I just want to compare both regimes. Personal Income Tax Act right now, the compensation for loss of office, say if someone loses his job or is asked to go, the act provides that the first 10 million is not taxable. The only amount taxable is income that you receive above 10 million. But right now it has been increased from 10 million to 50 million. So if someone is relieved of his duties and is paid 50 million, or not just for loss of office, injury or something, whatever happens, and you are paid above 50 million, the first 50 million is exempt from tax. It's only the portion above 50 million that will now be subjected to capital gains tax at the rate of 30%. So that's the difference between both regimes. Then, major one is consolidated relief allowance. Under the current provision, when you calculate your gross income before you slam the tax rates on it, you are expected to take 20% of your gross income plus either 200,000 or 1% of the gross income. So if your gross income is above 20 million, you take 1% and you add it to it, right? But if it's not up to that, you add 200,000 to 20% of the gross income and you take it as a relief. But right now, that has been phased out. And the reason this was phased out is because it disrupted the progressive tax regime. Like one of the cardinal principles of taxation I explained earlier is the equity principle. High income earners should pay more taxes. So with this consolidated relief allowance, you see that people, the high income, high net worth individuals, we are earning about 21% exempt income because of this consolidated relief allowance. So it was punitive to the low income earners. And so they phased it out and now replaced it with rent relief. And it's important to know that this rent relief is on actual rent pay. So if you're not paying rent, there's no relief. If you are paying rent, you must provide evidence of your rent paid and provide the name of the landlord. That's when you can take this relief. And it's subject to a maximum of 500,000. So double taxation and tax credits. Yeah, this is very, very important because before now, like I said earlier, if you are earning income, say in a place like Dubai or any of these countries that doesn't have a double taxation treaty with Nigeria, if your income is taxed there and you bring your income into Nigeria, it will still suffer tax because the bandwidth for taxation is income brought into Nigeria, accruing in Nigeria, derived from Nigeria. So if you bring in that income into Nigeria, it will be taxed in Nigeria, although it has suffered tax at source in Dubai. But right now, what the Act is providing for is that, yes, we know you've earned income in Dubai. Whether we have a double tax treaty with them or not is irrelevant. We'll just compare the amount you've earned, subject it to tax, and then you will take a deduction of what they have deducted already. So if I put numbers to this, you earn $1 million and they take 5% of that, or say 10%, $100,000 as tax in their jurisdiction. The moment you bring in that money into Nigeria, and Nigeria is saying, okay, to be taxed at say 15%, 150,000 is supposed to be paid as tax. Instead of you paying 150,000 of the remaining 900,000, they will assume that the 100,000 you've paid in Dubai is part of the 150,000. They only take 50,000. So this essentially ensures that double taxation is eliminated and tax credit is gotten for taxes paid. So I've done a simulation here, but I can't go through it because of my time. But I believe the slides will be made available so you can just look at it. It's just a simulation based on the information here. For this employee, Obina Animashang, he has annual basic pay of 10 million, annual transport, annual housing, and all this. So when you look at this, then he makes 5% voluntary contribution, and his rent is 1.5 million. If you look at it under both regimes, you discover that under the Personal Income Tax Act, as it is now, his effective tax rate is 16.61%. This means that he's paying 16% of his total income, of his taxable income as tax. Meanwhile, when the Nigerian Tax Act comes on board in January 2026, his tax rate is going to drop from 16% to 15%. That's a welcome development. But if you flip the coin, imagine his annual pay now goes up to 20 million naira, annual transport 3.6, annual housing 4 million. Look at it. The effective tax rate jumps from 17% to 18%. It's just minimal, because if you look at it, the amount he's paying is not, the difference is not so much, because his total tax under Personal Income Tax Act, as it is now, is 5.2 million, and under the Nigerian Tax Act is 5.4 million. So the ball is in your court. You want to earn more, pay more taxes, or you want to remain as it is. But I believe you want to earn more, because you want to contribute to the development of the country. Because when you pay taxes, good roads are built, the street lights, the security, the pipe-borne water, ideally speaking. Thank you. Then, this is a simulation I just did because of the increase in the minimum wage. So, under the Nigerian Tax Act, you see that those earning the minimum wage of 70,000, they're totally exempt from tax. In fact, like I said earlier, the goal of this legislation is to exempt as many people as possible, because someone can't be suffering and then you ask him to pay tax. Which brings me to minimum tax as it was before. You know, I said they've replaced it with minimum effective tax rate, which is 15%. But minimum tax before now, or as it is now before the Nigerian Tax Act comes on board, even if you make a loss or the tax paid is lower than it should be, the Act says you should assess yourself to minimum tax on your gross turnover and pay. So even if you're making a loss, you are paying minimum tax. But when Nigeria Tax Act comes on board, there is no more minimum tax. So if you make a loss, you've made a loss. And that's amazing. So these are tax filing obligations. As employees, you're supposed to file your tax returns on a preceding year basis. Oh, sorry, I have to rush. Time. But I just have to look at this. This is very, very important. These are penalties for non-compliance. So the Nigerian Tax Administration Act mandates you to register for tax. Whether you're an individual or a business, you should register for tax. And the failure to register is 50,000 in the first month and 25,000 naira in every subsequent month the failure occurs. So once this act comes on stream in January 2026, as an individual, if not registered, you start incurring penalties, right? Because a lot of things will now be woven together to ensure that you have your tax clearance. Like for now, if you want to travel out, you must present your tax clearance certificate. So there are a lot of things that will be dependent on tax clearance. So if you don't pay taxes, if you don't file, if you don't register, your penalties are increasing. And eventually, when you now need it, all this will be compounded. And the amazing thing is that it will be compounded and interest and penalties will apply. So if you do business with an unregistered person, it's 5 million naira. Yes, although there's a provision in the current withholding tax regulations, though this for companies, if you say you purchase something from someone and you're supposed from a business and you're supposed to pay and you don't withhold taxes, there's penalty. And if the person you're doing business with is not a registered person, you're supposed to deduct withholding tax at twice the rate. So if the rate is 2%, you multiply it by 2 and deduct at 4%. The goal is to ensure that everyone is registered, because taxation, one of the driving points of taxation is data. If there's no data, then you really cannot access taxes. So, and yeah, this is very important to mention that from next year, the government is going to be deploying AI tools, be deploying fiscalization system. What this essentially means is that they are tracking all the resources, all the money coming into your accounts, and even before you file taxes, they already have the information. So imagine you file and you say you are liable to pay 100,000. They bring out all your inflows into your account, bring out all your outflows, juxtapose the two, and then it's showing that your tax payable is 12 million and you filed 100,000. So you now have the onus of justifying, right? So compliance is easy and it's better to comply, because the penalty, if you see I put them in red ink to show that it's really, really very, very important. And you see, failure to grant access for technology development, like I said, if you deny them the access to install technology, is 1 million for the first day and 10,000 for every subsequent day. And if your transaction, because taxes in Nigeria are paid in the currency of transaction, so if you do a dollar transaction and you don't pay, then you don't report or pay taxes on it, there's a penalty of 10% on it, right? And then it is compounded. There's interest that's compounded for Naira currency. For transactions in Naira is at the monetary policy rate, but the spread that will be determined by the minister. But for dollar-denominated transactions, it's at the SOFR rate, the overnight lending rate, plus a spread. So you see, it is easier to pay and then close it out than use the money to generate cash flow or do business, and then eventually you want to pay. At the point of payment, the interest you will pay, it would have been better you should have paid it earlier on, because if you had used that money, say I was supposed to pay government 100 naira, I used it to do business, and eventually I made a profit of say 5%, 105 naira. And then eventually when I go to pay, my tax liability is computed and there's penalty of 10%, and there's interest at monetary policy rate, which is about 27% now. So just imagine paying over 127 naira when I should have paid 100 naira, and I made profit of 5 naira. It's no. The liability will be too much. So it's cheaper to comply than not to comply. Then VAT, there's a penalty for not deducting or failure to register or failure to use the fiscalization system. So there's penalty for everything. And if you have a false claim of VAT, 100% of the amount claimed, government will collect that money back and then impose interest on it. So there are other penalties listed in the act, but I just felt these are the important ones to know. So you'll be asking yourself, what should you then do as a taxpayer? So in rounding up, number one, register and obtain a tax ID. Whether you need it or not, just have it handy. And once the law comes on board, there's a plan to harmonize this tax ID, because right now you want to pay taxes in Lagos, you have to register for tax. You want to pay taxes in Ogun State, you register for tax. You want to pay in Abuja, you register for tax. And it doesn't make sense. And then there's a federal government joint tax board where you register and obtain a tax ID. So they are working towards harmonizing it, so it becomes more like your BVN or your NIN. Just have one tax ID. And secondly, track income and maintain proper documentation. Like I said, tax is data. Ensure you keep data. Ensure every expense you make on your business, every purchase you make, every supply you make, ensure that you're collecting invoices, because a point will come. Tax is data, information, and documentation. You said you spent 500,000 on transportation. Where is the evidence? If you cannot provide evidence, bank statement is not enough. You must get physical evidence, get invoices, get vendor confirmations, and ensure that proper data is maintained. In fact, audited statements, as a small business, if you can't get audited statements, at least just ensure you just keep proper records. That's it. Just ensure proper records are kept. File tax returns within the statutory time frame to avoid penalties. Invest in strategic sectors. So the reason I put this here is because there's I didn't have time to talk about it. There's the economic development tax incentive in the new act when it comes on board. So for companies investing in gas, for companies investing in agricultural sector, they call them priority sectors. All these sectors, they have some sort of tax incentives. And so it makes them realize more profits. And with more profits, there's higher dividends. So look out for all these sectors where the taxes are very low and then invest in them. Such that way you secure your capital and you secure your interest and dividend. So invest in research and development. Before now, research and development was capped. You couldn't take everything as tax deductible. But right now, it's tax deductible subject to 5% of your turnover. So invest in research. The reason this is done is to boost innovation and ensure that businesses are growing. And finally, on this slide, monitor the tax landscape. If possible, get a tax consultant. Because right now, tax has moved beyond finance. It is moving to the boardroom. Everybody is supposed to be aware because it's sort of the system is convoluted right now, so that you can't divorce tax from finance, you can't divorce tax from planning, you can't divorce tax from effective administration of your company, whether it's a small business or a big business. Just ensure that your taxes are properly accounted for. In closing, I'll quote our beloved president on the 26th of June when he was signing this. He said, and I quote, "For too long, our tax system has been a patchwork, complex, inequitable, and burdensome. It has weighed down the vulnerable and shielded inefficiency. That era ends today. We are laying the foundation for a new regime that is fair, transparent, and fit for a modern, ambitious Nigeria. A tax regime that rewards enterprise, protects the vulnerable, and mobilizes revenue without punishing productivity. This is the goal of this tax reform. It is not meant to be punitive. It is meant to encourage growth and development of businesses. Because when businesses develop, when businesses grow, the economy thrives. And when the economy thrives, the government has more revenue. When the government has more revenue, it invests in more infrastructure, invests in strategic projects that eventually makes the populace happy. Everybody's good. Imagine a Nigeria with 24 hours power, with security. All this is possible if every business becomes responsible, not just to taxation alone, but to other fiscal responsibilities that we are obligated to. Thank you. Thank you for listening to me. I will hand over to the moderators.
Wow, what a fantastic section. Please, let's celebrate our facilitator, please. Celebrate him in the comment section. Celebrate him in the comment section as you gather your questions. I mean, it's been a fantastic time. I mean, I've just been writing, from changing the threshold from 35 million to 50 million. Now we have NRS. Our record keeping is very important. Our tax is the backbone of the economy. And then the last set of points that we have to register and obtain tax ID, track your income, and then you have to document. Documentation is very, very, the delivery is spot on. Wow, what a section. Wow. And then we should invest in strategic sectors and also in research. We should monitor our tax landscape. Please, let's keep celebrating Mr. Daniel Bona. What a section. Wow. So, sir, we have a question here. Someone is asking, how do I get tax deduction for rent? That's John Ayodele is asking, how do I get tax deduction for house rent? I think our moderator has went to take water to step down. He's been talking since a while. So I think another question also, please keep dropping your questions. I'll read them out. And then you can raise up your hand if you would like to use the mic so that we give you the mic. Someone is also asking, Mr. Daniel, are you there? Please, let's keep dropping our questions if you have questions. Okay, I will unmute you now, sir. Okay, I think you can unmute now, sir.
All right, thank you. Thank you very much. So
Okay, well done, sir.
For rent, according to the provisions of the tax law, the rent deduction is 20% of your rent or subject to 500,000. So you can only take deductions when you provide evidence that you actually paid that rent. So I believe rent invoice will suffice, duly signed by the landlord, and you must provide the landlord's name and, if possible, other details. I believe all this will be communicated once the act comes on board. But right now, the provision is that you must provide evidence that that rent was actually paid and then provide details of the landlord. Thank you.
Thank you very much, sir. Messi George is asking, is there a particular age to start paying tax? Or is it a law as long as you are employed or a business owner?
So the law defines taxable persons, and like you know, tax is on profit and on income. So there's no particular age to start paying tax. Once you start earning income, you are responsibly supposed to pay those taxes. So there's no age for taxes. And for businesses, it's clearly defined as a threshold. Once you cross the 50 million naira threshold with a fixed asset of not exceeding 250 million, you're supposed to pay taxes, supposed to pay. And I must state at this point that paying taxes is an offshoot of filing taxes. So whether you have tax to pay or not, you must file taxes. You must file, and then eventually, if there's tax to pay, you pay. But then there must be this digital footprint that you've been a compliant individual, compliant business. And this is very important, especially for people who are looking to take loans or looking for grants from international donors, venture capitalists, angel investors. They must see that you're a responsible business. And one of the ways they measure responsibility of business is in tax compliance. Thank you.
Thank you very much. Someone is also asking, if someone that pays close to 2 million annually for rent, am I entitled to tax relief, or how do I claim it? If this person is paying around 2 million.
So if you pay 2 million, the law provides that you compare 20% of that amount with 500,000. Say 2 million, 20% of 2 million is 400,000, and the cap is 500,000. So your relief is 400,000. It's when you pay rent that is above rent that 20% is above 500,000. That so no matter how much you pay, the maximum amount you can claim is 500,000, but it must be actual rent paid. So if on your invoice is 2 million, you can only take 20% of that, which is 400,000. Thank you.
Thank you very much, sir. Jennifer is asking, is it okay to register for my ID in January 2026?
So for me, I'd advise that you don't wait till January, because the whole process is automated. You can just Google join tax board or just Google obtain my tax ID, and they'll guide you on how to obtain it. So you shouldn't wait till January. You can obtain it as soon as possible.
Okay, so do it now, like Nike will say, do it now. So IJ Nathan is asking, since tax is on profit and income, what about gifts? So if my uncle from Canada or US is sending me money, would that count? Would they have to tax that?
So amazingly, because I was rushing, I didn't mention that. Prior to this time, or the current legislation, gifts are exempted. But right now, honoraria, gifts, they are actually mentioned within taxable income in the Nigerian Tax Act. So if you receive gifts, you receive honoraria, you receive all those things, you're supposed to report them and tax it. It's part of taxable income right now.
Wow, that's serious. Amarachi Unwako is asking that she's hearing about profits and income. What about personal savings account and domiciliary account?
So before now, with the provision of the current tax provision, interest on domiciliary account is tax deductible, but that has been deleted from the act. So what that essentially means is that when you earn interest on your foreign currency, foreign domiciliary account, it's taxable now.
Okay, we have some people raising up their hand. Amarachi, have you asked the question, or you still want to ask another question? Amarachi Nwanko.
Yes, please. I want to ask another question. I've heard a lot about businesses. So what about your personal account. So for people that do their businesses with their personal account, like what's the policy? And then also if you do business with your personal domiciliary account, not a business domiciliary account, how does the policy apply to you? And also, for instance, somebody closes a major deal like from overseas, maybe say $10 million. What would you advise the person to do in terms of collecting their money? Can they collect their money at once in their personal domiciliary account? Would they be flagged? Would the bank freeze the accounts? Like, how does the policy apply in those instances?
All right. Thank you. So I believe during the presentation, I noted that taxes apply to individuals and to businesses. So essentially, personal income tax applies to individuals, and individuals in this case is a business can be classified as individual if it's not registered as a corporate entity, right? So if you're doing your business with your personal accounts, I'll advise if you can open an account specifically for the business, it's better, because the provision of the act is that you are taxable on your worldwide income. So to the extent that you cannot separate that business from yourself, which is it's still an individual, then you'll be subjected to tax on that, on your total income. Like when I was explaining the taxable income, I mentioned income from trade, business, vocation, or profession. And in the same bucket, there's income from employment. So all this will be aggregated. So it's better to have a separate bank account for business. Because take, for instance, the tax authority is asking you to pay tax, and you cannot differentiate between income that's for your personal expenditure, income that's for your personal income and then income of the business, because they're all housed in the same bank account. So it's better for you to have a separate business account. And for receipt of income from overseas, irrespective of the amount, it's not just tax implication it has. There is a mandatory, EFCC is mandated, or the banks are mandated to report to the EFCC when a certain threshold comes into your account. Even though I find that disturbing, because it seems the government doesn't expect you to prosper. Because why will the EFCC report me when I receive $1 million or receive $10 million? It means you didn't expect me to receive that kind of money, and yet you're expecting me to prosper. It doesn't make sense, but it is what it is. When you receive such amounts, income tax is on income. So you will, to the extent that you cannot prove that money is just say for sales, then everything will be aggregated and taxed. But to the extent that you can prove that, I received $1 million from abroad, but this $1 million is not totally profit. There's an element of cost in it. I render the service, and so this is my income. And once you can provide, like I said earlier, just documentation. If you have the receipts, the invoices, the agreement, the contract between you and the vendor, then it's just a matter of you presenting the information, and only the portion subjected to tax will be taxed. But note that everything that comes into your account must be reported. In fact, they will be seeing it once they integrate technology.
Okay, sorry. One last thing. Oh my gosh, the question just slipped my mind.
Okay, you can type it in the comment section when you remember.
Yeah, thank you.
Mary, you can ask your question now.
Okay, thank you very much, Mr. Daniel. On a lighter note, I'd like to meet with these people that made the reforms, because we need to ask some questions. But I want to ask on VAT. So how is it compiled? Like, if I walk into a store, for each item, am I supposed to pay tax or VAT on each item? So I walk in and I'm getting a pair of shoe and a dress. Is the VAT supposed to be on each item or the total sum of the both items? That's my one question. And the second question is, I'm running on the tail of the business, a person who has a small or medium scale business. So when am I liable to start paying tax if my business is not registered? When I eventually register my business, would I pay a backlog for how long I have been operational, or from the start date or when I register my business? Those are my questions.
Okay, thank you very much. Thank you for your first question. You just brought an issue I omitted because I was rushing. So for VAT, the blanket provision of the Act is that VAT is chargeable on all taxable supplies. However, there's a difference between exempt goods and zero-rated goods, because right now, basic food items, medical items, they are classified as zero-rated. And what this means is that with zero-rated, I didn't have time, I would have spoken about input VAT and output VAT. With zero-rated, you can net off input VAT with your output VAT, and then it will show whether you have VAT to pay or you have a refund to claim. So when you walk into a supermarket, their system is already automated, such that for natural, like I said, basic food items, even currently right now, raw foods, water, they're all exempt from VAT. But if it's packaged, if it's refined, then there's VAT on it. So when you look at the invoices they issue to you in any supermarket, you will see there are some lines that VAT is not applicable, because the goal of this legislation is to ensure that prices of basic foods crash, even though, well, it's to ensure that the price of food will crash, right? So that's why basic food items, fertilizers, locally produced materials, exported goods, there are exemptions and they are zero rated, classified. So when you walk into the supermarket, just be on the lookout, because and it may not even be a supermarket, because sometimes people just use VAT to inflate costs, because you're supposed to pay for the entire thing. The onus of remittance is on the vendor, the person selling, because you're supposed to pay the VAT to the seller, except you are mandated by the Nigerian Revenue Service to withhold VAT. You're supposed to pay everything to the seller. People just use VAT to hike costs. So you should be on the lookout for things. That's why I said taxation is no longer for finance managers, it's for everybody, it's for the boardroom. Be on the lookout for things that are not VAT, are not chargeable to VAT, so that they don't use it to inflate costs for you. And then you mentioned small businesses. So the provision of the Act is that the current provision is that when you float a business, within 18 months of floating that business, right, you should register. In fact, at the point of the way it is now, once you register a business with CAC, your taxpayer identification number, the TIN of the business, is printed together with your CAC. So you're supposed to just take that, walk to your tax station. When you check the registration on CAC, you can verify which tax station you are registered in. Walk to that tax station, open a file, and then you are registered for taxes. So there's no divorce between registration of business and filing or paying of taxes. But it's very important that you do it, because whether there's activity or not, you're supposed to pay. You're supposed to file taxes, right? The onus is on you to file taxes, whether you are active or not, whether the business has even started. Because sometimes you just register a business and there's no activity. It's supposed to just to file, right? The goal is data. Nigerian Revenue Service is pursuing data, and with that data, they can expand the tax net. In fact, there's a provision in the law that provides for people to file their taxes themselves. They want to simplify it in such a way that businesses can file taxes, businesses can pay taxes without needing external help. I hope that answers your question.
Yes, it does. Thank you.
Thank you very much, Mr. Daniel. I think there's another question in the comment section that says, what's the threshold for domiciliary accounts? I don't know if you get that, sir. For domiciliary accounts.
This is not very clear, because there's no threshold. Any money that comes in, the government is seeing it.
What I was asking was,
sorry, I can't hear you.
Amarachi, please unmute your mic.
oh, okay. Okay, so can you hear me now?
Yes.
Okay. So what I was asking was, you said something about if you pass the threshold, that the bank is meant to report to the EFCC about the amount of money that comes into your account. So I'm trying to find out what's that threshold for domiciliary accounts.
So currently, I'm not aware of if there's any threshold for domiciliary accounts, but for
Okay.
individuals, it's if I remember properly, it's 5 million for individuals. 5 million naira, sorry, 5 million naira that comes
5
into your
million
account, not
across,
even domiciliary. So imagine
across
you're receiving
to
$1
bank
billion
account,
into your account
all
on it to be flagged. And this is not from a tax perspective; it's from a financial perspective.
Okay, so do you mean 5 million across all accounts?
No, no, for
Like,
personal accounts.
okay, so does that include
I think we
domiciliary
should have
accounts?
bankers on the call. Someone should clarify for me. There's a threshold. Should have bankers on the
Okay.
call.
Okay. Thank you, Mr. Daniel. Chino, so you can unmute your mic and ask your question now. We're rounding up already.
Okay, thank you very much. Thank you, Mr. Daniel. You did say that currently, if people register a business, it comes, and that makes remittances quite easy. But before now, if you register a business, a small business, it comes with tax ID. And for instance, if you have a business that is currently inactive, I don't know if you render the service of maybe trying to submit the necessary papers to CAC and to make it active, and also to, help with tax remittance for a business that is inactive. Because sometimes CAC doesn't make those processes easy for business owners to carry out. Yeah, I think they have agents that do that. So I don't know if you render that service. Thank you.
So if you're asking if I personally render those services, I can assist with that, but it's not something I do. What's the English now? Where I can assist you with that, I can guide you on the process, because we know the administrative bottlenecks we face in this country. But one of the assurances we got when these bills were being onboarded is that all those bottlenecks will be eliminated. In fact, it's the goal is to ensure that you have direct access to the system such that you can interact with the system, file your taxes, pay your taxes without needing any external help. Yes, I'm available and willing to help.
Thank you very much, Mr. Daniel. Mr. Sars, you can ask your question now, sir. You can unmute your mic.
Mr. Daniel, my question borders on those that transact businesses as a person, and then the business with which they transact business issues them an invoice, which they will tender at the point of remitting their taxes. My question is the tax regulators, are they going to come after the person that has done that business who issued an invoice to the business now remitting tax? Because I did a quick search during your presentation and I discovered that the tax evasion rate in Nigeria is very, very high, and that regionally in Africa, Nigeria's tax evasion rate is higher than every other country in Africa. So I was amazed that the level of technology you said has been deployed into the system such that it's going to track every loopholes, and everyone within the tax bracket will be covered, yet we'll still have as much loopholes. So back to my question, I am a businessman. I've issued an invoice to a company for a business I did for them. The company is remitting tax now, and then they have presented that invoice as part of their remittance that XYZ did business for them. Now, how is the tax regulator going to, come after me, given this large scale evasion that exists in the system? Thank you.
So thank you very much. Although I'm not so clear with the question. So the invoice you're talking about here, is it a tax invoice and evidence of remittance, or just please make it very clear to me?
Evidence of doing business.
Okay. So so if you render service to a company, right?
Yes.
Sorry, I'm trying to understand you. You render service to a company and they present that invoice to the tax authorities. Is that what you mean?
Yeah, so the tax was not deducted, right? So it is expected that the person that rendered that business is going to remit the tax as an individual entity.
Okay. So, okay, let me just put this in context, I think. Please correct me if I don't get you. So basically what the system provides for is that if you render service to a vendor, at the point of paying you, they're supposed to withhold based on this. And the withholding tax rates is based on the kind of service rendered. Like for supplies, is 2%. For professional fees, 5%. So when they deduct that 5%, they're supposed to pay you net of 5% and remit that 5% to the tax authorities, which will be an advance payment of your own income tax. So at the point of you filing and paying your income tax at the end of the year, you already have 5% with the tax authorities. So whatever you're going to pay, you deduct that 5% from it and then you pay. That's the situation.
So it is the flip side. So in this instance, there was no withholding tax certificate presented. So it is assumed that you are to pay the tax, that 5%.
Oh, no. So for withholding tax, the obligation to withhold and remit is on the party making the payments. So the obligation is on them. So if they don't withhold and remit, if they pay you the entire amount, you're not subject to any penalty, because at the end of the day, you're going to pay your full income tax based on your income you've assessed yourself, less your expenses. So when you're paying your tax, say you've calculated your taxes and you have tax of 2 million to pay, you pay that 2 million. But if they had deducted, they wouldn't have paid you the entire money. If they had deducted and remitted, instead of paying that 2 million, you deduct the amount they remitted, they deducted, and then you pay the balance. But in a case where they didn't remit, they paid you the complete invoice, you go ahead to pay your tax, but the law provides that they will bear the penalty for not deducting. And the penalty is as high as 40%.
Of the transaction.
Yes. Of the tax not deducted, yes, it's as high as that.
So what's your take on the rates of tax evasion in Nigeria as compared to regional members?
Tax evasion is not just I would say it's a cancer, because it's terrible. Like the last data I had, Nigeria loses about $18 million annually to tax evasion. And that's the reason why these reforms have come. And that's the reason why they are deploying technology. And that's the reason why they're imposing penalty as much as 1 million naira for refusing to integrate into the fiscalization system. Because, and a lot of tax evasion, sadly speaking, is committed by high net worth individuals and then the informal sector. Because you can't track them. There's no paper trail. There's really no data with which to track them. So you lose that revenue. Government loses that revenue. So it's so high. It's not just something that's limited to Nigeria. It's everywhere. If you look at the news, there sometimes you see on the news people who are convicted of tax evasion in the United States, and it's a very, very serious offense in the United States, in the UK. In Nigeria, is not so prevalent. However, with the onboarding of this new technology, with the onboarding of this new tax act, it's going to be very, very serious, because the government is frowning at tax evasion. That's why the penalties are so high, because the goal of the penalty is not to take money from your pockets, is to dissuade anybody from engaging in tax evasion. But like we always know, some people will count the cost and still decide to evade the taxes, but it's not. And there are some times where it's not as if you're evading taxes. Some things are just beyond the control of the business. Say, for instance, you're supposed to file taxes, and one of the documents you're supposed to submit is your audited financial statements. In a case where the auditors did not finish in time, instead of you, the statutory deadline for companies is 30th of June, and financial statements are not ready by that time, and you've not applied for direct assessments or payment on account, it's beyond you at that point in time. You cannot file, you cannot pay, because it's beyond you. So there are sometimes where there are instances where the tax evasion is not really intentional. It's just a cornucopia of some issues that prevented you from filing or paying. But like I said during the presentation, it is cheaper to comply, because once this tax act comes on board, the cost of non-compliance will be very, very high. Thank you.
Thank you, sir.
Thank you, Mr. Daniel. What is section? Please let's drop in the comment section. Thank you, Mr. Daniel. As you round up, it's 10:30 already. Please let's celebrate. We really appreciate it. Thank you for taking your time to attend to every question one after the other. Over to you, Madam Rose. Sister Rose, are you there?
Yes, I am. Thank you everyone for joining us. We welcome those who are joining us for the first time. We see you, we love you. We hope you come back again. And to those who have always joined us, thank you so much. We appreciate you. We cannot do this without you. And quickly before I'll just say this, that this event session happens bi-weekly. So we have another for August, the 6th of August, and it's beyond likes and links, building relationship. So make it a date with us to stop by August 6th, and you can also always go revisit the sessions that we have had on our YouTube channel. We are also live there. This session is always streamed. You can go back and watch. We have left you a link in the comment section. We are trying to collate data from those who join us, from our participants. So you could please fill the form. It takes about 1 to 2 minutes tops so that you can fill it. And to end this session with a closing prayer and to wrap up the session, we'll call on our grand patron, Pastor Olulade, to give us the closing remarks and closing prayer. Thank you, sir.
It's been another enlightening night tonight, Mr. Obona. This is fantastic delivery. We underestimated the power of your delivery. You won't mind us if we'll not just only thanking you, but we are telling you that we would be calling you back after we've taken enough time to digest it and the official release of the document from government. Thank you very much for everyone's participation tonight. Let's go there and do the needful so that we'll be good citizens of this country and we also grow. Shall we have a word of prayer? Lord, we thank you very much for tonight, for adding value to us. Thank you for our facilitator. And thank you, Father, because you are moving us forward. We pray you bless him abundantly. We pray you also enrich our lives too. We pray you take us forward, every one of us, so that we live value-added lives on a daily basis. Thank you very much. We appreciate you, Lord. In Jesus' name we pray. Amen.
Amen. Thank you very much, sir. Thank you, everyone. Thank you for joining tonight. And this is how come to the end of the section tonight. Remember, taxes and debts are very constant. So be a good citizen, support the country, and have a wonderful night rest. Good night, everyone.
Good night.